A little here to my left can weigh in. But John, when you think about where we are, stocks relative to the S&P 500, we've talked about that maybe being the quote new Dow theory. Old, as you know, transports relative to the Dow Jones index. Regardless of how we're categorizing it, it has been lower and lower, really against some of the macro headwinds here on the horizon.
It's the only time we talk about the Dow, for good reason.
I know.
Thank you.
And I'm never invited back on this show now.
Of course, you're welcome any time. In the next segment too, Taylor Riggs is going to count you down to the close a little bit later on. I wanted to talk about foreign exchange as well. Year to date on foreign exchange, the moves have been absolutely phenomenal. And I can tell you where we are currently because of the bounce back in sterling in the last couple of hours. Sterling's no longer the biggest loser in G10 against the US dollar. That's still the Japanese yen, down by about 20%. Sterling's down by 19.8%. The Swedish currency down by 19.5%. Norwegian currency down by 17.5%. The euro's down by about 15%. The relative outperformer in G10 against the US dollar, the loonie, Canadian currency, still negative 7.3% year to date. Crazy stuff. The S&P 500 very, very close to the year's lows, and the strong dollar this year, Kelly Lyons, has not helped.
Strong and continually getting stronger. I mean, all hail King Dollar, John. It seems to be the only thing anyone wants to buy right now, up against everything in G10. As you said, as there is a narrative that hawkish central banks, specifically the Federal Reserve, particularly the Federal Reserve, are going to keep supporting this dollar, while other central banks hiking cannot do enough to support their currencies. Just look at the euro or the pound for an example of that. And this seems to be the narrative that this isn't going to change anytime soon, that there isn't much standing in the way right now of dollar strength. Obviously, that has big ripple effects, including for stocks, especially those big multinationals that have significant exposure overseas, because the value of the sales made elsewhere is worth a lot less when it has to be converted back into dollars. So those FX headwinds are quite large, and that is something that Mike Wilson over at Morgan Stanley pointed out in research this morning, saying that by his calculations, every 1% change in the dollar index has a negative 0.5% impact on profits. So he said fourth quarter S&P earnings will face an approximate 10% headwind from the stronger currency. That may help explain why S&P companies with low international sales are outperforming those with high international sales, which is that blue line we're looking at here on this chart. Of course, the currency impact is felt in other classes, asset classes as well, including commodities, because those priced in dollars are more expensive for overseas buyers. So that, coupled with demand concerns around a deteriorating growth outlook, has dragged hard on the likes of the metals, with copper down about 30% over the last 6 months, gold down about 16%, and of course crude sub $80 on WTI. We are at the lowest levels since January, John.
Kelly, awesome work this morning as always. Kelly Lyons there. I want to pick up on that quote that Kelly just used from Mike Wilson and Morgan Stanley. If you want the numbers again, I'm happy to share them with you. On a year-over-year basis, the dollar index is now up 21% and still rising. Based on our analysis, that every 1% change in the DXY has around a negative 0.5% impact on S&P 500 earnings. As Kelly said, fourth quarter S&P 500 earnings will face an approximate 10% headwind to growth, all else being equal. Morgan Stanley's Mike Wilson. Tony DeSpirito of BlackRock joins us right now. Tony, I'd love to get your thoughts on that dollar call from Mike Wilson and the team and what it means for this equity market. Just how much damage can we expect from this FX market to this equity market stateside?
So, thank you. Good morning, John. So I think the earnings outlook really faces two headwinds. One is what Mike Wilson is citing, which is the strong dollar, and I think that is easily quantifiable, which he has done. The other, quite honestly, is the slowing economy. You know, the Fed started hiking in March of this year with a 25 basis point hike. You know, if you talk to any economist, and any economist will tell you those rate hikes impact the real economy with a lag, at least 6 months, but many would say a year to 2 years. And so we haven't even begun to feel the effects of that on the real economy and hence on earnings. So I do think the earnings outlook is cloudy. Now the good news is valuations have come down a lot, right? The market started the year with the S&P trading at over 20 times earnings. That's now down to a much more normal 16 times earnings.
Tony, just in terms of how far you would push this out, to your point, the dollar story, easily understood, easily quantifiable. The story you're talking about, the rate hikes, a lot of that means it's already baked in and the slowdown in our future is already guaranteed. Tony, how far would you push that slowdown out through next year?
Yeah, so I think it's really through the first half of next year. Now, the market can react much more quickly than the real economy. So I do think that once the Fed pauses or even pivots, right, that'll be a positive signal for the market. So we as investors have to stay forward looking, realizing that the earnings outlook is for weaker earnings, but on the flip side, at some point we're going to get a Fed that has to reverse itself.
Until then, Tony, what on earth do you do?
Yeah, so my recommendation has really been to stay balanced, right? And in terms of that balance, I've been leaning the portfolio I run, the BlackRock Equity Dividend Fund, more towards stability sectors, right, to help ride through whatever earnings hiccup we're going through. Now, there's a challenge there because many of the stable sectors that you go to, utility staples, are very overvalued, trading at 20% premiums to the market, and history tells you, that buying at that level might feel good in the short run, but in the long run, over the next 12 plus months, doesn't pay off. That said, I'm seeing a lot of I see a lot of possibility in the healthcare sector. That sector is trading at a roughly 10% discount to the S&P 500, despite having good long-term growth characteristics as well as good stability in a recession. And so I'm seeing a lot of opportunity there.
Tony, how much has your world changed in the last 12 months with a 2-year that's gone from 20 basis points to something close to 4.3?
Yeah, look, I think that's what's caused the dramatic change in valuations in the market. The market's gone from, like I said, over 20 times earnings to a much more normal 16 times. So that's really the good news, is that valuations have corrected. But like I said, I think we've yet to see the fundamental impact of those rate increases, and that's what keeps me tilted towards stability.
And Tony, do you need that rate increase to stop going up or come back down to get that kind of enthusiasm back into this equity market?
Yeah, I think the market would be really excited by a pause. And so I think that's really what the market needs.
Let's see if we get a pause, Tony, because listening to Chairman Powell last week, it was anything but one. Tony DeSpirito there. Mislav Matejka over at JP Morgan. And Tony, thank you for being with us as always. Mislav Matejka of JP Morgan writing the following on some of this. It should be increasingly probable that the next months could see some dovish tilt by the Fed. This could act to limit further moves up in long yields. There could be a good entry point for another bouncing growth at present. Tech stocks in particular could do better. Be interested to see if Marko Kolanovic and the team here stateside for JP Morgan echo some of that a little bit later, because this market has gone against their calls in a major way. The equity market about 11 or 12 minutes into the session shaping up as follows. We are just about unchanged on the S&P, just about positive on the Nasdaq by 0.6%. Coming up, the Fed facing criticism from Washington once again as it hurries to tame inflation.
It's going to be hard. It's not going to be easy. There will likely be some job losses. We're going to do all that we can at the Federal Reserve to avoid deep pain.
Senator Warren has things to say. That conversation, I'm next.
It's going to be hard. It's not going to be easy. There will likely be some job losses. There's a really good chance that if we have job losses, it's going to be smaller than what we've seen in other situations. We're going to do all that we can at the Federal Reserve to avoid deep, deep pain. And I think there are some scenarios where that's likely to happen.
Senator Elizabeth Warren taking aim at the Fed once again as the central bank moves to tackle inflation, writing in a tweet over the weekend the following. Fed Chair Powell seems determined to push the economy over a cliff, even after he admitted rate hikes won't lower key prices. Destroying jobs and crushing wages of millions of workers is reckless and dangerous. Recession is not the solution to inflation. Emily Wilkins of Bloomberg Government joins us now from D.C. Emily, how alone is Senator Warren? How much company does she have?
John, really, that is the sort of question to ask here. Certainly, Senator Warren has been a critic of the Fed, of Jay Powell. This is not the first time that she's come out and really questioned the strategy that they are doing in rate hikes. She says that obviously some of the reasons that we're seeing inflation have to do with things like COVID, things that the Fed doesn't necessarily have control over. But it's important to note here that we're really seeing kind of her as a bit of a loner in this field as far as really calling out the Fed. Remember, Jay Powell, he got renominated with the support of a strong bipartisan number of senators really backing him here. And so it's clear that he does have the confidence of a lot of Washington, even though he is going to have a couple critics like Senator Elizabeth Warren. But at the same point, it seems like most of D.C. is confident and willing to trust him with these rate hikes that they will eventually lead America's economy to being a little less high on inflation.
Emily, do you sense that that changes if unemployment goes from a 3 handle to 4 to maybe even a 5?
The difficult thing about rising unemployment, particularly for the White House, is that it has been their statistic that they've really clung to, trying to show that Biden has done a good job with the economy. They tend to ignore the inflation number and stick with unemployment. That narrative is going to have to change if you see unemployment rising. Even if that is something where the Fed is trying to prepare people already, going out, saying, hey, there's going to be some pain, but it's going to be worth it in the end, the White House is going to have to figure out a way to ride that wave. And if it starts coming in the next month or so, right near the election, that could actually have impacts as far as voters going to the ballot box and voting against the party in power, Democrats.
Couldn't agree more. Emily, it's a complex moment. Emily Wilkins there down in D.C. We've asked this question a million times. How do you convince people that higher unemployment, the loss of your job, is a price worth paying to get inflation lower? That's a very, very difficult job to do, and that may well be this Fed's job to do that job before year end. Complex stuff. Equities right now on the S&P unchanged. On the Nasdaq, we're positive 0.6%. Big week ahead. Ton of Fed speak. Sprinkle of data. Taylor Riggs has more. Hey Taylor, look, you're back just like that.
See,
Told
I'm
you could come
allowed
back
back.
any
This
time.
is amazing.
I told you. You're
I
never
knew
banned.
that deep
Give me a
down you
break.
were so generous,
Big
John.
fan.
Let's take a look at the generosity of this Federal Reserve. As you said, a lot of Fed speak up here, so really going to be hearing from them. We did, of course, you just played a great sound clip, of course, from Raphael Bostic of the Atlanta Fed. He'll be back up on deck around noon. And, of course, in our hours in the closing bell, really focused on Loretta Mester of the Cleveland Fed as well. And that is just today, because if you take a look at the calendar for the rest of the week, yes, it gets busier and busier, talking again about some of the job losses that we heard from Raphael Bostic, but it is necessary, if you believe this Federal Reserve, to bring down inflation. I think, John, for me, what really stood out were the big comments from Jay Powell last week, talking about our message has not changed from Jackson Hole. That is going to be the key here, if they can reiterate that tone as well as we push forward to the rest of the week. Finally, I'll wrap up some of the data for you. Last week, and that's a lie, it wasn't even last week, it was like within the same 24, 48-hour period, G10 central banks had hiked 300 basis points. So this is a U.S. hawkish Fed, but this is a global central bank hawkish narrative underway.
Taylor, for a long, long time, it was our currency, your problem. When do you think this starts to become their problem? These moves are big, big, big moves in foreign exchange.
And take a look at the Mike Wilson note out this morning, talking a lot about the big dollar pressure that is putting on not only the world of equities, but every central banker to the rest of the world. And this is where Jay Powell comes in, as you know, this central banker to the rest of the world, when they really start to think about dollar strength. And is it dollar strength or is it pound weakness? As you know, with currency pairs, it's a little bit of both. Today, it might be more about that pound weakness relative to some of that big dollar strength we've seen.
What a trading range it's been on sterling, and the day still has some hours to go. Taylor, welcome back anytime. You know that. Taylor Riggs, we'll catch up with her later on today and, of course, tomorrow on this programme. The Fed speak. It's ridiculous. At the end of the Fed news conference with Chairman Powell last week, I turned to the former Vice Chair, Richard Clarida. If you didn't see it, I turned to him and said, the bad news is that the quiet period for this Fed is over. And he couldn't stop laughing. And I imagine you're finding it quite painful because you're going to get a ton of Fed speak today. To Taylor's point, you'll hear from the Boston Feds, Susan Collins, you'll hear from Bostic, Logan, Mester. That's just today. And then you'll hear from Evans and Bullard and a whole lot more tomorrow as well. So tons to keep up with. About 21 minutes into the session, talked a little bit about the equity market and where we are at the index level. Let's get you some sector price action. Here's Abby.
It's pretty interesting here at this point, John, because we're up slightly on the S&P 500, reversing a greater than 1% loss in the pre-market. That appears to have to do with that 2-year yield coming off of its high, still higher, but not as high as it had been. Now, yields up, that should mean, and it does mean, utilities and real estate, those high dividend yielding sectors, are down. But it should also, in this current environment, mean that the mega cap sectors are down because valuation becomes a concern. That's not the case. We have consumer discretionary, tech, and communication services on top. The financials, which you would think would get a bid on yields up, this is the conundrum of the year. It is down. Now, over the last 5 days, it's been brutal, as you know, John. If we take a look at the sectors over the last 5 days, big declines. Interestingly, the worst sector, though, is energy, down 10%. So this year's up sector, the big up sector, it's down over the last 5 days as oil has tumbled back below $80 per barrel. Today, a little bit higher at this point. But you have also real estate down, discretionary down, materials down, really nowhere to hide. Today's small gain for the S&P 500 right now, up about 0.1%, John, right above that June low, as you were talking about. It's on light volume. It's going to be interesting to see, of course, how the day plays out.
Abby, thank you. Thank you very much. Talked a lot about the Fed speak. Do you want the ECB speak from Christine Lagarde? Monetary policy has to deliver on its mandate. Fiscal measures, these headlines are fascinating. Fiscal measures can help in tackling inflation. The aid must be targeted, temporary, tailored. Wide fiscal measures are not helping monetary policy. After a decade of asking for it, they're getting it, they're complaining about it. Seeing more wide than tailored fiscal aid right now. The length of volume of any TPI, you know, all that stuff, any buys there will consider inflation. Some assumptions in the ECB forecasts have been overtaken by events. You think? That's ECB President Christine Lagarde on a tape in the last 10 minutes or so. Coming up, the market moving events you need to be watching. I'll bring you the trading diary in just a moment. In the equity market, about 23 minutes into this session, equities on the S&P up by a little more than 0.1%. And how about that for a bounce back on the NASDAQ? Up by 0.8% on the NASDAQ, even with yields pushing just a little bit higher. From New York, this is Bloomberg. little more than 25 minutes into this session this Monday morning. Good morning. Just about positive on the S&P, nicely positive on the Nasdaq, up 0.8%. Unexpected earlier this morning. Given what was happening with the bond market, that fades a little bit as well. 2s, 10s and 30s, your 2-year, 12 months ago, something like 27 basis points. Right now, 421. It was pushing through 430 a little bit earlier this morning. We fade that story too. That's the price action. Here's the trading diary. What you need to be watching this week begins with the President speaking at 4 p.m. Eastern Time, then a busy slate of Fed speak with Collins, Bostic, Logan, Mester, all on the agenda later today. Chairman Powell speaking tomorrow morning. ECB President Christine Lagarde speaking again on Wednesday. We get US GDP and initial jobless claims on Thursday, and we round out the week with personal income and spending numbers and the UMich Sentiment Survey on Friday. From New York, that does it for me. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Monday, September 26th. Here are the top market stories that we're following for you at this hour. It's a UK market in crisis. The pound hitting a record low in overnight trading, and the gilt yields jump a whopping 100 basis points in just 2 days. So it's over to you, Bank of England. Investors bet the BOE will hike 2 full percentage points by November as traders and the government look to the central bank to bail them out. And surviving this market is a little bit of relief in equities this morning. We break down how to trade with almost $5 trillion in cash sitting on the sidelines. From New York, I'm Alex Steele, my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. I have to be honest, it's really hard to believe this rally that we're seeing, particularly tech up about 1%.
Yeah, I think after such an aggressive move last week, it is unsurprising that we do see something of a little bit of a bounce. Maybe it persists, maybe it doesn't. To be honest, I'm really struggling with what is happening outside of equities, Alex. What is happening in the bond market, particularly European government bond markets, I think is really challenging right now. What is happening with the currency markets, take a look at what is happening with the pound, but also just take a look at what's happening with the euro as well, breaking down too. There's a lot of things happening here. What is the cause of them? I think there are probably multiple causes.
Yeah,
but it's all starting to feel a bit febrile, isn't it?
Yep, and I just want to point out, Christine Lagarde also talking right now, the two headlines that stick out to me is they want to reach neutral, and then we'll decide if more is needed, but they don't know where neutral is, but they're going to get there. I have no idea how you price something like that in.
More hikes. Further to go. I think that where ultimately the destination is, I don't know. Nor does she, by the sounds of things, nor does the Governing Council, but we have still got further to go. And I think that probably is the message that is being conveyed by central bank after central bank after central bank. The question, you and I kicked this around first thing this morning, and things are starting to feel like they're either breaking or broken. So is this, and this is our question of the day, is this what broken looks like? Is kind of our question of the day. Trying to answer that, to give us a sense of what is happening here, is live macro strategist Simon White joining us from our MLive team, and we've got Kriti Gupta from our Bloomberg team over in New York as well. Simon, I'm going to start with you. Is this what broken feels like?
It does to me, very much so. You look at what's happening in the UK markets, there's pretty big moves, historic moves. Some of the biggest moves in gilt yields have seen in many, many years. You're looking at like previous crises now as your only reference points. So whether it's the ERM in 92, the IMF crisis in 76, they're your only really kind of strong reference points that we have right now.
Kriti, I'm trying to figure out too, if we look at say, okay, markets are broken, this is what it looks like. Yeah. Who's underwater at this point and how much? I have to think that like banks' VaR assessments are through the roof right now.
They are, but I also have to argue the opposite point that Simon just made. I don't think they're broken. In fact, I would argue this might actually be, this is going to be a contrary opinion, but they might actually be working even better than we thought they were. In fact, because there's so much change, because there's so much changes in pricing, the fact that the market is actually able to execute it, I think that is worth saying. This isn't like 2020 when you had a lot of margin calls. I mean, yet, we'll see. But this isn't like a plumbing issue. You're not seeing markets necessarily unable to cope with it. You're just seeing a lot of people get burned very quickly. But in terms of repricing, the consequences of Trustonomics, getting repricing the consequences of the Bank of England, and arguably what the Federal Reserve might do, plus also any chance of potentially currency intervention. I've started to hear that phrase get seeped back into the conversation. That coordinated effort, or the potential for a coordinated effort, all of that is getting priced in quickly, which is creating the volatility. But I think that's a sign of a successful market.
Simon, thoughts on that?
Yeah, I mean, that's fair. I mean, I guess when I'm saying markets are broken, it feels like the UK is broken, which isn't necessarily the markets. The markets probably are by and large in the right things. Liquidity is very light. Moves are still very volatile, so you're not really getting the same kind of like information from price moves as you often get in volatile markets.
So I guess the point, is the signal we're getting from markets accurate? I guess is the question maybe that we should be asking. Are these markets weighing risk correctly?
They're telling you that a lot of the underlying fundamentals that were fine in a sort of upward growth environment of low inflation are now massively problematic, and they're more problematic in other countries, or some countries than others, and the UK is one of them. You're running massive external deficits in a rising dollar environment, which is resource constrained. You're going to have problems, and the UK market is showing us today that the UK has these problems.
So Simon, and this is where I feel like the rubber meets the road, and maybe you and Kriti the convergence will happen, is that if the UK markets are broken, at some point that breaking is going to spread, right? I mean, if I'm an asset manager and I wasn't short the cable rate, I mean, I'm in so much pain. What else am I selling? And that's where I wonder how it spreads.
Yeah, I agree with Kriti. It's not like, this is not the GFC, okay? So the markets are functioning kind of fairly well right now. So I don't really anticipate contagion at this moment from the UK, but there's obviously going to be spillover effects. I mean, people are starting to reassess certain things, as I say, they took for granted. That again, that you can't just run massive current account deficits without a problem. And the situation again, you've got the Bank of England having to raise rates into this environment with high inflation. These are a highly sort of series of problematic events happening at the same time.
Critty, does this just make the US even more attractive though? And is that just a self-perpetuating problem? As the US becomes more attractive, everybody else's problem becomes even greater. Our currency, your problem, feels very, very relevant today sitting here in the UK.
You know, in theory, that would make sense, but we've been making the argument, I want to say, for at least since the start of the year, and you haven't actually seen those fund flows flow into the United States the way everyone was expecting, and a lot of that is going to be because the dollar creates such a large hurdle. It's getting more and more expensive to enter the market, especially for Europeans and folks in the UK as well. What I think is important when we're talking about the contagion effect that Alex really brought up is that what's going on in the UK is serving as kind of a warning or a poster child for what you're going to see in the United States. Think about the kind of commentary you've been hearing out of Washington, the idea that if there is a recession, who needs to help pay for that recession? Corporations. You have to deal with more stimulus, student loan forgiveness, while the Federal Reserve is going on this kind of hawkish tilt and this very aggressive move on potentially 75 basis points in November and beyond. Now you look at what's going on in the Bank of England and essentially mitigating the effects of what the BOE is trying to do, and I think it's a massive warning to the likes of the United States and other central banks around the world.
Okay, so to that point, Simon, let's say the BOE comes up and say, all right, guys, we're going to stem the tide here with the falling cable rate. We're going to control yields. We're going to hike 100 basis points. What happens?
Well, again, it's, you know, they're on the back foot. The ERM, that's what they tried to do. They raised from 10 to 12%. The market went, or cable went down. Then they had to, you know, they were going to raise another 3 percentage points. And at that point, they just gave up. You know, they came out of the mechanism. So it's a big ask. I mean, they've got 50 basis points priced in over the next week. 200 or 175 by the next meeting. But it's shock and awe time, and really nobody knows what exactly is going to be enough. Do too much, it looks extremely panicky. Do too little, of course, it's going to undercut and not achieve the aim. So it's very binary kind of outcome.
I'm just also wondering, like, what are they waiting for? Like, what level do you have to see to get in here? Guys, thanks a lot. Simon, we roped you into radio and I roped you into TV. Be careful. Simon White, Bloomberg, and Critty Gupta, thanks so much for joining us. All right, coming up, staying with the topic, our next guest says the market's gone from looking overbought to now oversold. We're going to talk with the U.S. head of equity and derivative strategy at BNP Paribas, Greg Battle, next. This is Bloomberg.
when the Fed makes its call.
A unanimous Fed raises the benchmark rate 75 basis points.
Bloomberg is there with live coverage.
We anticipate ongoing increases will be appropriate.
The market's responding to this, as you might expect.
And instant expert analysis.
Do we want this Fed to force a recession?
They're saying that forward guidance is dead. It is very not dead.
We keep being surprised at how durable inflation is.
The risk is skewed to doing too much.
They're choosing the lesser of two evils.
Nobody covers the Fed like Bloomberg, your global business authority.
I think actually you're probably closer to buying bonds than stocks.
What we're seeing here is, some acts of desperation.
I find it hard to label this a panic.
If you are starting to get to levels where the income is becoming a little bit more interesting.
I think if the government had more credibility, markets would be more sanguine about it.
Policymakers wish they can use a scalpula. Instead, they're using a sledgehammer. And when you use a sledgehammer, you're going to break things.
The moves are extreme, but they are explainable.
It's quite clear the Bank of England do need to step up.
Does the Bank of England intervene? If you can't see this as a genuine panic, I don't think they do. I think they stand back and see how markets play out.
The concern here is not so much that the UK cannot service its debt. That's not really the issue.
I think at the minimum, the dollar is going to be weaker at the end of next year than it is today.
So now we're looking for 97.50 in cable by year end.
That doesn't mean it's easy to trade the next month or two.
Those are just some of our guests weighing in on the market action, which takes us to the question of the day: is this what broken looks like? Joining us now is Greg Battle, BNP Paribas U.S. Head of Equity and Derivatives Strategy. Is this broken? Is the market broken? Is this what it looks like?
Good morning. Well, I think the news flow has been pretty challenging across equity markets. I'm not sure that the U.S. equity market at least is broken. We've certainly seen a precipitous decline from the highs in August. We now think the market is starting to look oversold. So we think tactically there is actually some room for a short-term bounce. But there's no doubt the news flow that we have seen over recent weeks and the news flow we expect to see through October looks pretty challenging.
Greg, what does broken look like then from a U.S. equity point of view?
So I think broken from a U.S. equity point of view really means some more manifestation of the bearish narrative within corporate earnings and within the outlook for corporates. It has been a challenging year for equities, and we do think we could see more downgrades coming through. But as it stands, we haven't seen a real wholesale taking down in terms of sell-side numbers this year. So the street is still looking for about 8% earnings growth next year, and I don't think that necessarily sounds broken. We might think that's a little bit too high. But that's where the risk lies.
But to that point, what PE multiple do we need to price for a moderate versus deep recession?
Well, we've already seen a massive compression in PE multiples year to date. The question as to whether we see more of a compression in terms of PE multiples, I think is more likely to be driven by rates than it is the earnings outlook. So the real problem for equities is that we have two twin headwinds. One is, where are earnings going to be next year? Will the cyclical decline be larger than we expect? Do we see earnings downgrades? And then the second part of the question is, what multiple do you prescribe to those earnings? And when we look at the rate of change in terms of things like the yield environment in the US, where we are now in terms of 10-year yields versus where we were a month or 6 weeks ago, that's what's driving the PE compression story.
Okay. If I'm looking ahead and I'm thinking there is more downside to come, and you've just laid out the case for it, how do I protect myself? Do I just sell equities? Do I buy protection to protect my portfolio? How would you suggest hedging the risk that exists in the market at a reasonable price?
At a reasonable price is the difficult question here. So what we've seen year to date is a real degrossing of institutional positioning, and we've seen a reach for protection. If you look at things like index put volumes in US equities, they've really picked up to very elevated levels. So one of the things that institutional investors are trying to navigate is, how do you hedge an equity portfolio when equity volatility is already elevated and is not reactive to moves on the downside? So we think there is a difficult path to tread here, where if we get a further decline in terms of US equity markets, we're not necessarily convinced it's going to be accompanied by an explosive move in terms of volatility or the VIX. So we think we have to be quite nuanced in terms of how we add hedges at this point.
So what do you do? How do you do it?
Well, I think one way to do it is to look at various option structures that don't leave you with an outright long volatility bias. The easiest way to hedge a equity portfolio using options is just to buy options outright. You buy a put option, you spend premium, hedges you for a specific downside move. There are structures you can take that will look for a more controlled descent, whether it's a put spread, a more exotic option like a put with a knockout based on a level of spot or a level of volatility that we can use to try and cheapen those options. Effectively, the theme that we've been talking about is trying to hedge the body of the distribution and not necessarily hedge the tail, which is the most expensive part of the optionality. Now, clearly, this comes at a cost. You're not going to be as well hedged in the case of a tail event, but what we're worried about more is the body of the distribution and more of a continued slow grind lower than we are an explosive March 2020 or 2008 type scenario.
Greg, a lot of people have gone into cash. What do you make of that as a strategy?
Well, it's been a successful one year to date. I mean, it's been very hard to find hiding places this year. We've seen the price action from the bond markets, from credit, from equities. But the issue of being in cash is we are in a relatively kind of high inflationary environment. So I think the theme this year is it's been very hard to find places to hide. And our view is that if we're looking at dipping a toe into the equity market, it has to be done on a much more tactical and nimble way than maybe some of the kind of more sustained trend following that we've been accustomed to over the last decade.
The not fun question, how much more upside could there be to the dollar based on positioning?
So I think in terms of where FX markets go, really it's going to be a function of rates as much as anything. So I think the thing which has really kind of caught asset markets off guard over the recent months has been the extent of the move that we've had from rates, the competitive hawkishness that we've seen in central banks. And that dollar move has indeed been problematic for US equities. Strength in the US dollar mechanically takes down our expectations for earnings from those overseas earnings. So dollar is another headwind that you can add to the kind of pain for US corporates.
Greg, on the other hand, a lot of people in Europe are looking at the euro. They're looking certainly today at the pound and thinking, do I want to have sterling-denominated, euro-denominated assets in my portfolio? As a result of which a lot of money has been flooding across the Atlantic. If we were to see any kind of stabilization in Europe, if we were to be able to put some of these crises behind us, how much of a coiled spring is there to see money flooding back across the Atlantic in Europe's direction?
Well, when I think, if we take a look at European equities, I think few would argue that European equities are one, under-owned, and two, cheap on a relative basis. So those two tailwinds are there, but the issue is that hasn't been a good indicator historically for timing equity markets. Buying markets because they're under-owned and cheap isn't normally a good strategy. What you really need is a catalyst. You need the fundamental or macro outlook to improve, and if people believe there is a sustainably better fundamental outlook, then clearly the fact that those assets are cheap and under-owned means you can have a disproportionate move to the upside, but I don't think those things are alone sufficient triggers to get us more constructive on European equities.
And we're definitely not there yet. Greg, thank you very much indeed. Greg Battle, BNP Paribas. Thank you very much indeed. Still ahead, well, let's talk about it. The pound plunging, sparking talk of emergency action from the Bank of England. We're going to get the latest on that story. When is it going to happen? Will it happen? That's next. This is Bloomberg.
About that all day yesterday.
It's time for the Bloomberg Business Flash to look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Perella Weinberg Partners is naming longtime investment banker Andrew Bednar its next chief executive officer. Bednar is taking over from co-founder Peter Weinberg in January. He has been co-president of the firm for more than 2 years and has worked on some of the firm's largest transactions. Credit Suisse says it's working on possible asset and business sales. The Swiss bank is looking for ways to cut costs and restore profits under a strategic plan to be announced next month. No details yet, but Bloomberg has reported that Credit Suisse is considering the sale of its Latin American wealth management operations, excluding Brazil. And the CEO of Unilever plans to retire at the end of 2023 after only 5 years on the job. He presided over a tumultuous period where the consumer goods company botched a potential $53 billion deal and irked investors with lackluster growth. Unilever's board says it's starting to search for his successor. And that is your latest business flash, Guy.
Ritika, thank you very much indeed. The sell-off in UK assets going into overdrive early this morning. The pound crashing down to an all-time low versus the US dollar. This, of course, comes after the British government announced its new fiscal measures in a package announced on Friday by the Chancellor of the Exchequer. The UK Prime Minister Liz Truss spoke to CNN yesterday about that news.
And what I'm determined to do as Prime Minister, and what the Chancellor is determined to do, is make sure we are incentivising businesses to invest, and we're also helping ordinary people with their taxes. And that's why I don't feel it's right to have higher national insurance and higher corporation tax, because that will make it harder for us to attract the investment we need in the UK. It will be harder to generate those new jobs.
The Prime Minister, Lizzie Burden, joins us now from the Labour Party conference in Liverpool. Lizzie, let's talk a little bit about what is happening here. Clearly this is a government that is determined to be bold and brave. It is certainly being both. The market response has been brutal, to add an extra B into the mix. How is Labour looking at this as an opportunity? How is British business thinking about the chaos that is now reigning?
I couldn't quite hear you. I think you asked how's Labour looking at this as an opportunity. I mean, for what a scene setter for Labour Party conference. I'm here in Liverpool and you've had speeches from the Shadow Chancellor Rachel Reeves, the Business Secretary Jonathan Reynolds, in fact both of them on Bloomberg TV today, and the message is that the markets can trust them with the economy. Rachel Reeves emphasising her record as a former BOE economist, emphasising that she understands why markets matter, including to the cost of borrowing if they were the government. And then Jonathan Reynolds trying to make his pitch to business for why business would be supported under a Labour government. It's a difficult pitch for him to make because, of course, the Tories are dangling this big corporation tax cut, and the Labour Party's got to separate itself from its reputation under Jeremy Corbyn in terms of the relationship with business. But this is the message that they're trying to make, and they're going to have to convince people to buy into their idea of a fairer, greener economy. Lizzie, let's move the camera lens out a bit. Do we expect an interrate hike from the BOE? And what's going to be the impact of something like that? Well, market pricing suggests we can expect that, and Sky News reported earlier that we can expect to hear from the Bank of England in a statement later, but that has not yet been confirmed. The options that are at the Bank of England's disposal are they could do an emergency rate hike, they could slam the brakes on active gilt sales, remember there was talk of that before the meeting on Thursday, or they could just come out with some hawkish talk, and we're already expecting a pre-scheduled speech from Hugh Pill, the chief economist, tomorrow. So perhaps they'll go with just that to reassure the markets and wait until the November meeting to react to the budget, which is what they hinted they would do in the guidance to the last meeting, in which they actually said that they would be particularly looking at inflationary pressures from stronger demand, and they would be willing to respond forcefully to that. Right, it's a fine line there. Lizzie, thanks a lot. We appreciate it. We'll get you also in the next hour. Bloomberg's at Lizzie Burden reporting there. All right, coming up, I'm going to stay in Europe for a moment. It is a breakthrough for Italy's hard right. Giorgia Meloni is set to become the country's next prime minister. So we're going to talk with former IMF director Carlo Cottarelli about what Meloni's victory actually means. You see the BTP Bund spread continuing to widen out. This is Bloomberg. About an hour into the U.S. trading session, tech doing really well today. Volume pretty solid, but really it's hard to not categorize this as dead cat bounce at this point. Bloomberg's Abigail Doolittle tracking those moves.
Yeah, Alex. Well, depending on how you do categorize it, it does seem like a bit of a reprieve after all the selling that we've had, especially last Friday when we did briefly go back below 3,700. We tested that June low. The question is, will that be a bottom? Technically, probably not. So to Alex's point on a dead cat bounce, which I hate because I have a cat who I love, but this could turn out to be brief. And tech really doing better, which is so interesting because we still have yields higher. We have, of course, have that formula, yields up, stocks down, but that 2-year yield, it had been at 434. Now it's closer to 420, so not as high as it had been, so a little bit of a hope on the part of investors. Interestingly, the big story on the day, the pound absolutely crashing over the last 2 sessions, hitting a session low, or an all-time low, I should say, a record low. This, of course, as the UK, some news came out that they're planning on cutting taxes even more, really really weighing on the pound. Now, technically here, it looks like there could be a big spring back higher. It'll be interesting to see whether or not that happens, and if it does, what sort of an announcement could bring it. But very extreme movement in the foundational asset class, currencies, not just, of course, the pound, but it's also the euro, the yen, lots of movement there. That, of course, all that movement is sending the dollar higher. That has been pressing the S&P 500 lower. If we take a look at the S&P 500 and this year's bear market, you can see this massive decline earlier this year into a true bear market, then the bear market rally, now back down, testing that low. Again, the question, is this some sort of a bottoming process, a double bottom, whatever you want to call it? The charts longer term suggest no, that this is just a break from the selling that we've seen, and that there's likely more downside ahead as the central banks continue to raise rates in a feverish pace to fight inflation. But we do have tech bouncing back today, as Alex was talking about, and here are some of the big tech winners. A piece of this guy, it might actually have to do with, very interestingly, Macau saying that they're likely to allow group tourists come back to Macau this November, some of those high rollers from China. That, of course, is lifting up the likes of Wynn in Las Vegas. They received so much of their revenue from those from Macau, 70% for Las Vegas Sands, 40% for Wynn. But the point here is China tech is higher, up more than 3%. That could be one tailwind here for U.S. tech as well.
Abigail, thank you very much indeed. We need all the tailwinds we can get right now, whether they're attached to cats or not. We've just had some breaking news. There's a lot of cats around today. The U.S. September Dallas Fed index down pretty sharply, the business index. So the totality of the data maybe turning a little bit uglier. The labour market data is still holding up, though, in the United States. Let's turn our attention to what is happening in Italy. The country is on track to have its first female Prime Minister. Giorgia Meloni won a clear majority in yesterday's election. That sets her up to head the most right-wing government in Italy since World War II. Meloni spoke about the results a little earlier today.
It seems clear to me that what came out from the first projections is that Italians in these general elections have expressed a clear indication that they want a center-right government led by Brothers of Italy.
Let's go to Rome for some analysis. Maria Tadeo is there for us. Maria, she won big, she won huge, but she didn't win big enough to get herself a supermajority. What does this all mean?
Well, Guy, and I was there at that moment of the night. At 3 a.m. in the morning, she appeared at that headquarters. She sounded like a winner. She looks like a winner. Of course, if you read behind the scenes, it's very clear she expects the President of the Republic to give her the mandate. She'll lead the next government. The country now turning majorly to the right is the end of the Mario Draghi era. Of course, a lot of question marks in terms of what that may mean for the economy, for foreign policy, but also the relationships with countries like France and Germany. Italy does need a good working coalition with Emmanuel Macron, with the German Chancellor. There's a lot of question marks around it. You're very right. She did win big, but there isn't a super majority here. But I think in terms of Giorgia Meloni, it doesn't change a lot for her. She knows she's taken or will take the top job, but there's a lot of questions in terms of what Giorgia Meloni will mean for this country.
Well, to that point, Maria, I'm looking at the BTP Bund spread. 239 basis points is now where we're at for the 10-year. What can we read into that in terms of where we were Friday and then where we are now?
Yeah, and look, going into an Italian election, you would expect that reaction to feed in the BTP market. We haven't seen a lot of moves there. There's a combination of factors here. One is, as you know very well, the European Central Bank is very active in this market still. And then, of course, the big difference in this election, particularly in the campaign, which we followed very closely, is that there was no debate around Italy exit. There was no debate around the euro, whether or not Italy would crash out of the euro. None of that featured here. And she's also said she's not looking for a clash immediately with Brussels. So I think a lot of that fed into the BTP market and the lack of moves. But to talk about this, I am happy to say we are joined by Carlo Cottarelli, who of course is a professor at Università Cattolica. You have such a long background now in international relations, economics. You were running yesterday as a candidate in the election. To put it diplomatically, it wasn't really a good night, well, for you or PD, the Social Democrats. But I want to ask you, you wake up on the Monday morning and you look at the situation in this country. How would you define Italian politics this morning? What can we expect from this new government?
First of all, the good thing is that the market reaction has been
quite no major problem, which is what I was expecting. What will matter in the future is what the government does. If they do what they promised they would do, I would be a bit concerned, especially in terms of relationship with the European institutions, Germany, France. I'm a bit less concerned regarding the fiscal accounts, because Meloni has been quite, at least in words, but we'll see later, but she has been quite cautious about the management of the fiscal accounts. When Salvini was saying, let's add another 30 billion of deficit, she was saying, well, let's wait, it's not the right moment, we have a high public debt. So the main concern is how this will develop in terms of relationship with the European institutions, especially with respect to the recovery plan, the implementation of the recovery plan.
And what's going to happen there, because that's the key point for markets, whether or not that gets changed. The idea was that Mario Draghi set the foundations, and whoever comes next will continue on that path. Do you expect her to change it?
In the program of the center-right who won the election, there is explicitly the intention of renegotiating some aspects of the plan. It's not clear what, but if they put it in their program, clearly it's not minor aspects, otherwise it wouldn't be worthwhile talking about. So it's going to be a surprise in a way. We don't know what exactly they have in mind, but they say we want to renegotiate the plan, which I'm not even sure it can be done in major way. Article 21 of the regulation of the Recovery and Resilience Facility, which is the facility from which the money comes, says that the actions of the plan can only be changed if they become impossible for objective reasons. So you cannot go there and say, we changed our mind.
Like the energy crisis. Would that be an objective reason?
If the reasoning is that there is an increase in the cost of production, then you renegotiate the amount of money. And that, I think, will be possible. It's uncertain what will happen in this negotiation. But changing the objectives, then it may become more of a problem.
And Meloni, she was a big winner of the night. I mean, there's no question about it. But she has a massive crisis in front of her. Not a lot of experience in government. Can she deal with the storm that's coming in the winter?
Hopefully. I have to hope as an Italian, yes. Leaving aside politics. Some people question whether Fratelli d'Italia, the Brothers of Italy, her party, has the people who can manage running a country.
She has no experience in government.
She has no experience. She doesn't have people who have a lot of experience. But you know, it's very often we in Italy, we jump on the car of the winner. So I'm sure you will find people.
You fix it along the way. That's the Italian way. But I have to ask you, on the European Central Bank, the head of the European Central Bank, she said, we have tools now to prevent unjustified volatility in the market. Well, what's justified and what's unjustified? When you look at the moves in the BTP market, is it fair? And how do you differentiate what's political and what's not?
Yeah, I think when Christine Lagarde said that, she had in mind a new tool, the TPI.
Yeah.
And the TPI is for countries that are fine, but they are unjustifiable. There is an unjustifiable attack from financial markets. And they list the characteristics of a country that to distinguish whether there is a justifiable or not justifiable attack. One of the conditions is that the country is in line with the recovery plan, the implementation of the recovery plan. Which goes back to, that's why it's dangerous to say we start renegotiating the plan, because Italy could be caught in the middle of a speculative attack. Italy goes to the bank, European Central Banks, and they say we cannot intervene because we are not in the line with the plan. And so it's a difficult situation.
It's very tricky for her.
It will be very tricky to be in that situation.
And I want to ask you, this campaign on the political side, there was a big question, and it's a serious allegation, to say that she was almost semi-fascist, that this was a return of perhaps a neo-fascist movement in Italy for an international audience. Is Italy now led by new fascists?
No, I don't think so.
No?
It's a conservative party. They explicitly say we are conservative in the same way as I would say, the most extreme part of the U.S. Conservative Party is conservative. but it's not a fascist party.
Very briefly, 30 seconds. Do you know who's going to be the next finance minister? Do you have someone you would hope?
I don't want to come up with it. I have some ideas, but I don't want to come up with any name.
And this is going to be the big speculation in the next few weeks.
Yeah.
Carlo Cottarelli, thank you, so much for joining us and being here after what was a difficult night for the Italian Social Democrats.
Definitely.
But this is politics in some ways.
Politics.
Well, thank you so much. Alex?
All right, Maria, thanks a lot. Great interview. Really appreciate that. And while the interview was taking place, here's a fun headline for you. Christine Lagarde says the ECB is going to consider quantitative tightening once rate normalization is complete. We have no idea when that's going to be, though, because she goes on earlier to say that they want to reach neutral, and then they don't know where that is. So, okay, I don't know how to determine all of that. I think it's probably really hard, Guy, particularly when you take a look at something like Italian politics. How do they protect against the BTP spread blowing out too much?
Well, if you're doing QT, that's really bad news for Italy.
Yeah.
Very bad news for Italy.
Although that's once the rate normalization is complete. Like literally when will that be? They don't even know. So how can the markets possibly know either at that point? Okay, we're looking at a live shot there of Christine Lagarde. So coming up, we're going to go back to the markets here. You got the slump in oil prices could trigger OPEC Plus intervention. It was a really tough week for crude last week. We're going to get Paul Sankey's view, a Sankey Research lead analyst. It's coming up. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. Ukraine's President Volodymyr Zelensky is calling on Russians to avoid the Kremlin's mobilization effort by fleeing or surrendering. Zelensky says that would help bring a quicker end to what he called the criminal war. Russian men fled to the borders over the weekend after Vladimir Putin's order to call up another 300,000 troops. The OECD has slashed its global growth forecast for next year, saying the world has been jolted by the war in Ukraine. The Paris-based organization says the global economy will expand just 2.2% in 2023. That is down from its previous forecast of 2.8%. The OECD also expects further interest rate hikes. And Germany's Chancellor Olaf Scholz went to the Persian Gulf seeking energy supplies. He ended up with just one tanker of liquefied natural gas from the UAE. There's also a memo of understanding from the Abu Dhabi National Oil to make more deliveries next year. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg, Alex.
All right, thanks so much, Ritika. So let's get back to our question of the day. And looking at markets, Nasdaq 100 up by 0.8%, but it has been a really insane couple days. Joining us now for the latest is Paul Sankey, Sankey Research lead analyst. And our question, Paul, is this what a broken market looks like? You've been trading not just oil, but in the market for a long time. Is it broken yet?
No, I don't think so, but I think it's going to keep breaking, right? I mean, don't lose sight of the arc of history here. You know, the land war in Europe is the first since the Second World War, so there's an epic event going on there, generational event. We've been looking at Japanese debt markets for 30 years, saying, when is this going to break? It's breaking. And of course, you know, you have what we might term an irresponsible mini budget from the UK that's just cratered the pound. And as you know, the speed of the moves here is pretty unprecedented. So it looks like a very, very tough setup, I have to say.
How much further do we have to go, though, Paul? As you look at what is happening here, there's a whole series of events that are unfolding around the world, from geopolitics to finance. There is a series of lines that you can kind of draw between them, and I'm wondering where you think the lines go next. What kind of is the next on that list?
Well, I think the biggest concern has to, the toughest thing at the moment is that you have very low unemployment. So, you know, ostensibly the global economic situation looks quite good when you're walking down the street. You know, jobs vacancies are at all-time highs, everything else. Life goes on whilst markets are cratering. So what we saw from the Fed, and I don't think I've ever known a time when Wall Street professionals are more cynical about the Fed. They're talking about, you know, the Fed having totally lost control, having no idea what they're doing, extreme views of how badly the Fed is doing in managing all of this. And all